One of the big stories of the day, MBIA announcing a deal to reinsure $184 billion of FIGIC-backed municipal bonds late yesterday. The monoline insurer is due to collect $741 million in premiums for lending this helping hand to its wobbly competitor. Now, in a First on Squawk interview, we're joined by New York State Insurance Department Superintendent Dinallo, who approved the deal and has made a lot of things happen in the last couple 6 months. Good to have you back.
Hi, it's
Eric.
good to see you again. Thank you.
This is sort of like a bigger brother helping out a little brother. I mean,
well, I think there's great synergies here. I think that it's obviously really good for the municipal bondholders of FIGIC, who now are going to experience some tremendous upgrade from junk status, which is where they basically were, to maybe A or AA, depending on how the ratings come in. But they're basically going from the rating of FIGIC to the rating of MBIA. MBIA, on the other hand, gets a tremendous book of capital, as you said, where they can begin to maybe write new business off of that. They could create a subsidiary, bring over the billion that you know that they're holding at the holding company level, and begin to write off a base, because a regulator requires some base to begin to write new business.
Right. Does it do anything, though, about the underlying health of FIGIC?
Well, I think it does, because what you see with FIGIC is they've commuted their most difficult CDS, which is the one with Calion. They have now additional capital, $200 million in, to begin the commutations process with the other CDS holders, and it gives them some time to rationally unwind all of those. So I think it is very positive for them.
Was it a hard deal to spin?
Well, I don't think it was a hard deal to spin. It was a very lengthy process. You know, I think the last time I was here, in fact, we said that FIGIC had filed for sort of a split book, and we were concerned about that. We didn't want to have to do a rehabilitation, which is like a bankruptcy for them. So we started this 30-day process, which ended up being like a 90-day process, because we got many, many bidders on the municipal book. So it's been a long process to go through that and help sort of choose with them what was the right transaction, and this turned out to be the right one.
Yeah. There were other bidders like Berkshire Hathaway who were looking for a much higher price. What was it, another $500 million?
Yeah, so the difference was they would wanted what's called a negative ceding commission. So they would want to have been paid 50% instead of what ended up being here, which is FIGIC was paid 20% of the book. And I think that reflects in part the difference of the ratings. Also, presumably Berkshire is not in need of that capital base the way MBIA wants to begin to start to write off of a fresh book.
You think that was a case of Berkshire being incredibly conservative, or if I'm an MBIA shareholder, should I worry today?
No, I think Berkshire is very conservative in these situations, and they can sort of wait out, and they don't need the business, so to speak. Right. They also have a higher rating, so they could arguably demand a higher premium. And I also think that, again, they have a fresh capital base, which is what MBIA is going to be getting here. I think what I'm really excited about is this cut-through reinsurance transaction. It is the potential to lead the way for other workouts and other backstops for, say, CIFG, which I think we're making substantial progress on, and SCA XL, which is in a much better place than it was, say, a month ago, but still there may be an ability there for cut-through reinsurance.
I was going to ask you whether or not you think you've picked the low-hanging fruit, or if there are more of these out there that you can write.
Well,
help organize.
Yeah, I think CIFG would be the next one to try to bring from junk status to some stabilized non-rehabilitation situation. What we've said is places like CIFG, SCA, FIGIC were in sort of a binary state. They were either going to go into rehab or come up with some kind of transaction, and we urged FIGIC, and we're working with CIFG to try to come up with a similar outcome. This would be, if you count this as about $1 billion, this would be about the 11th billion dollars that we facilitated into the market. And you remember way back in January, February, we thought the market needed between 10 and 15 billion. We told the banks that when we sat with them. And sure enough, it's coming in right around there, that when we're done with this process, we're going to be somewhere between 10 and 15 billion coming into the market. Not subsidized, not a bailout, because this is all private side infusions, but just about what we thought.
Right.
Eric, how concerned are you about the municipal bond insurance business right now with the new issuance? There was an article in the Bond Buyer that said only about 6 to 7% of new issuance is actually being insured. Does that worry you?
Yeah, it doesn't. I think what that reflects is still people are still trying to get comfortable with which areas of the bond market really requires the insurance. I think you've heard a lot about the large municipalities like Florida, General Obligation, California, New York, saying we don't need this. Arguably they don't, and the rating agencies should work with them. But there are tens of thousands of small municipalities out there, including school boards, museums, small towns, hamlets, water authorities, for which this is, I think, still the only option that I've been able to see.
Jefferson County, Alabama is now in debate right now.
Yes.
You're talking about $3 billion there.
Yes. Jefferson was not part of this cut-through reinsurance, by the way, because Jefferson, the claims are already in, the defaults they haven't technically defaulted, but there's a stiff situation there, and so we have a situation where that really, it could have been moved over, but the reserving for that would have been so high it wasn't really worthwhile, and so that's something to still be resolved. But again, because they've freed up the rest of the book, FIDGIC can now begin to work through with, I think it's about $4.5 billion in capital still on hand, that and the Wall Street CDSs that are left over.
It wasn't that long ago when we would have you on and your stomach would turn. I mean, not yours, ours, because we honestly didn't know what was going to happen. You know, it's something now people want to compare the next couple of months to what March was like for financials on a broad level.
Yeah.
Do you feel like you've ridden out the worst storm cloud you'll have to pilot?
My stomach was turning, let's be clear. And I think we've largely started to do what I have adopted someone's statement about this. Steve Roach of Morgan Stanley, I think, said it really well. It's sort of the theory of regulatory intervention. So you throw your body, the eye of the storm theory of regulatory intervention. What I think we did well here, if anything, is we sort of threw our body over a situation that had the possibility of sort of spinning out of control in an irrational, non-economic sense, and gave it time to see that a downgrade really wasn't the end of the world. It wasn't going to cause financial havoc as long as it stayed within a certain range, that capital could be infused, that we brought in Berkshire to start to stabilize the market.
Right.
And I think we are beginning to get to the resolution and the stabilization of the market, which I think has been positive for the credit markets overall.
But, I mean, outside of just reinsurance, right, or insurance, people worry about spreads on mortgages, spreads on junk. FDIC is going to have to tap some lines of capital somewhere for banks that are going under. Clearly, there's worry outside of your universe.
Yes.
Is it fair? Is it legitimate worry?
I think there is a good chance that we what sort of started, ironically, in the monolines is beginning to wave through the rest of credit. And there is a possibility that you see it in credit cards and student loans. It is clear that as a society, we engaged in some real moral hazard lending, I think, which is a sense what insurance sort of is. It's an underwriting.
Right.
And I think it's going to spread through. But I think that at least in insurance, we've sort of made it rational, and I think we've stabilized the markets quite a bit.
All right, you're talking about storms, though, and we've been watching Gustav, which is right now a tropical storm. If that picks up and becomes a hurricane as expected, if there is damage, what will that mean for the reinsurance business, which we haven't seen major storms or major damage in 3 years?
The reinsurance business right now is what we sort of call soft. The pricing is down because there hasn't been a major storm. If we see major storms coming through, you could see it harden quite a bit. One of the undertakings that Governor David Patterson and the insurance department have been talking about publicly is reestablishing possibly one day the New York Insurance Exchange to begin to get the capacity ready for such a demand. We have a very segmented reinsurance market in the United States, and we'd like to try to make it more synthesized, possibly have it sort of federalized without being federal, so sort of one-stop shopping. Maybe the New York Insurance Exchange offers that opportunity, and certainly if you see storms, the demand is going to pick up considerably.
You've got to have the most handsome dot drawing in the Journal of anyone we have on the show. You know, Becky and I used to work for the Journal, and if you weren't happy with it, we would make some calls. But have you seen this thing?
I did see it this morning. I thought the same thing.
It's like
George
a great
Clooney.
dot drawing. It's ridiculous.
Yeah, well, it just goes to show you.
Yeah, that's really, no.
Art over reality.
Oh, not true at all. You know, one more question for you. We've been watching AIG with all the financials. Is AIG under your control, too? Is that something you've been watching?
AIG is this is important to explain because it has to do with, it in some sense gets to MBIA and the $1 billion of the holding company. We regulate the insurance companies, which are often subsidiaries of larger holding companies. So when we say we regulate AIG, we regulate the insurance subsidiary. So we are, of course, very mindful of where they are. We feel that they have tremendous solvency there. The moat around the insurance obligations is very, very strong and serious. We don't technically regulate the holding company, which is where the structured exposure was written out of and what those problems have. And the tension always is people want, as you've seen with MBIA, they want access to the capital in the insurance subsidiary to try to help out if there's mistakes at the holding company or investments at the holding company level. So I feel confident about AIG as an insurance subsidiary. Others in the markets will have to decide about the holding company.
And you say, again, when you look at the money around it, you feel very comfortable?
Yes, we feel very comfortable about that. Yeah, from a solvency point of view of what they've insured. But by the way, just a predecessor of mine 20 years ago, I think, did a very good thing, which is notice that we contained the financial guarantee to just the monolines. You could have AIG and others having written these guarantees, but people thought that could be a contagion that would spread all through property and casualty. So one of the benefits of our insurance system is FGIs are contained into just FGIs as opposed to having an AIG writing these financial guarantees from their insurance company, which has not happened.
So it could have been a lot worse.
Could have been a lot worse.
Great to see you, Eric.
It's good to see you. Thank you very much. It's a pleasure.
Eric Dinallo coming on Squawk first.
Great to see you. Thank you.